Welcome back. A big takeover in the gold mining sector was announced earlier this week. Equinox Gold agreed to buy Calibre Mining in an all-stock deal worth, at today's Equinox price, about $2.5 billion. Equinox and Calibre say the new company will become the second largest gold producer in Canada, with the potential to produce 1.2 million ounces of gold per year from 5 gold mines in the combined portfolio. Let's talk about it with one of the people who made that transaction happen. Ross Beaty is chair of Equinox Gold and joins us now. Ross, thanks a lot. Tell us about some of the motivations for this transaction and how the combined company will be able to capture the benefit of record high gold prices.
Yeah, you bet, Paul. And thanks for having me. Well, this is just one of those things that comes along sometimes. It wasn't something that was planned. We weren't looking for any deals, and neither was Calibre. But I've known the management team and the two principals of Calibre for many, many decades. We're old friends, and we just sort of got together mid-year last year, and we are both building. Equinox is about a year ahead of Calibre. We just finished a very large gold mine construction project in Northern Ontario. Calibre is building a big mine in Newfoundland right now called Valentine. And we've looked at what the premiums come to companies in Canada that are large gold producers based in Canada, like Agnico Eagle and Alamos Gold, for example. And we feel that by combining these two big new Canadian gold mines, we'll also command that kind of premium, that kind of valuation bump. So it just seemed like a sensible thing to do, and we worked through all the due diligence and all the procedures you need to do to make these deals happen. And it just was a smart transaction that we think is going to make 1 and 1 3. Of course, scale matters these days, more than it ever has in the mining business. Whole new pools of capital, a lot of passive investors like the ETFs will be buying more of these combined company shares. We'll have better financial strength, a lot better ability to de-lever off the debt on our balance sheet. It's just a smart business. And it's not an acquisition, by the way. It's a real combination. It's kind of a merger of equals concept where we'll have combined boards, we'll have strength in combined management teams. The principles of Calibre aren't going away. They're not selling, they're combining. And we really think this is going to be a really accretive transaction for both sets of shareholders.
Okay, Equinox shareholders will own 65% of the new company. Calibre shareholders will own 35% of the combined company. It was described as a no premium transaction. I did not have time to run the numbers, but indeed, shares of Calibre actually declined on the news. So talk to us about the deal value and why no significant premium was built into the price.
Sure. Well, of course, when you do these kind of things, you do a lot of work on valuations. If it was a true acquisition, there would have been a premium, but this was a combination. It was a merger of equals concept where, we're combining assets, we're combining management teams, we're combining boards. And if you kind of look at the numbers, because of where these assets are, similar assets in Canada, we also have some assets in Latin America together. It's the kind of thing that for Equinox shareholders, it was a fair transaction to do this on a market-to-market basis. And similarly for Calibre shareholders, they had the same view, the management, the board, the fairness opinions were rendered accordingly, and this is just where things shook out. We definitely don't want it to be thought of as a purchase by Equinox, because that's not what it is. And when you have these kind of things, very often, share-to-share transactions where there's no valuation bump on either side at the outset are well rewarded by the market. You don't have any arbitrage opportunities. You don't have hedge funds coming in shorting one, buying the other, and so I think it's actually going to be seen when the initial trading sort of shakes out. Actually, it's doing that today. Calibre's stock is doing better than the Equinox stock today. It was a little bit of reverse yesterday, but I think over the next month or two, you're going to see a real parallel move between the two share prices, because it's a transaction that equally makes sense for each set of shareholders.
Okay, there's a big emphasis, and you've talked about it a bit, a big emphasis on the two new mines. So the new company enters the new phase of its existence with two mines that have either just begun production or are just a little bit short of beginning production. The Greenstone mine in Ontario is an Equinox mine. It began commercial production only in November of last year. The Valentine gold mine, which you've referred to, is in Newfoundland and Labrador. It's targeting its first pour of gold for the middle of this year. So talk to us about those two mines. How much gold, respectively, is each capable of producing, and when will each get to full capacity?
Sure. So we're ramping up Greenstone now. We expect over the next 5 years to average about 390,000 ounces a year from Greenstone at very low cash costs and all-in sustaining costs of around $1,000 an ounce. So it's going to be a really giant cash generator. And this year, I think we're targeting 300 to 350,000 ounces as we ramp production up to full capacity. It'll be every month we should do a little bit better than the previous month. That's kind of how these startups always work. And Valentine's the same thing. We're targeting actually fairly small amount of production in 2025, but it will ramp up to about 200,000 ounces a year, 2026 and beyond, again at low cash costs. So they're very similar operations. Greenstone's a little bit bigger, but I would say Valentine probably has better near-term expansion potential, and that would certainly be the plan as soon as we get the thing ramped up, is to actually add some mill capacity and make it a little bit of a bigger mine. So they're both early, very at the beginning of long-term lives. Both have fabulous exploration potential to extend mine lives, increase capacity, and together they're going to be better than just together. Of course, we'll become now the second largest Canadian sourced gold producer, which should give us a really good market pickup by investors who really love Canada as a destination for gold mining. It's a really tier one location. The other Canadian companies that are mining in Canada are getting really good valuations and premiums to their share price relative to others in other jurisdictions. Newfoundland is a great place to mine. Northern Ontario is a fabulous place to mine. So we're really happy with these assets, bringing them together.
You mentioned cash costs of production. What is the estimated pro forma all-in sustaining cost of production of the combined company?
Well, Equinox itself and Valentine Equinox has a lot of other production from Latin America, including the US, Mexico, Brazil. Calibre has production from Nicaragua right now and a little bit from Nevada. So the combined company will be producing, including all of the operations, in the range of $1,600 an ounce all-in sustaining costs, heavily weighted in future years, decreasing that amount through the production from Greenstone, new production from Greenstone and Valentine.
We will leave it there. Ross, thanks a lot for spending some time with us. That's Ross Beaty, Chair